I made $12,466.40 in just 7 trading days, and I did this using just one simple strategy. Now here's the payout proof from Funding Pips to showcase that this was a real payout, and here was the email from Rise of the payment hitting my account. Now this was done following this very stupid but simple strategy. So simple that I have multiple people that have been able to replicate these results. Here is just a few of the many students that I have who've been able to replicate these same exact results. So here it is, my stupid, simple, profitable trading strategy with an 88% win rate, my EBP trading strategy. Let's go ahead and define our terms. First, this is a bullish engulfing. EBP essentially stands for engulfing bar play. The bullish engulfing is defined by a candle where the price sweeps the prior candle's low, as it did in this example, and we have a close above the prior candle's opening price. This constitutes what is called a bullish engulfing. This is the exact scenario that we need in order for this to be present. Now, notice the price does not have to close above the prior candle high. For me, all I require is for the prior candle's opening price to be traded above and close above as well. So that is just very paramount, because some people in traditional senses, they would require the bullish engulfing to close above the prior candle's high. But for me, that's not the case. Now, inversely, we have what is known as the bearish engulfing, where price in this example sweeps the prior bar's high and we close below the prior candle's opening price as shown in here. Now, again, same thing. The price does not have to close above the prior candle's low. Again, some people in traditional senses require this. I personally do not. And also, I need this requirement of the stop run above the prior candle's high to include that as an engulfing. Some people, they can, like basic retail, they'll say that the engulfing is essentially engulfing the prior candle's body, or the prior candle, the full prior candle. For me, I just need it to sweep the prior candle's high as well as close below the opening price. That's it. Those are the two rules that I require in order for me to define something as an EBP. Now, we can use this simple strategy to trade this one of two ways. So in this video, I'm going to just focus on method 1, which is the method that has the 80% strike rate for where we can expect the market to go. Now, I'm not saying you're going to have a 88% win rate, but this system, method 1, does give you the directional bias with 88% accuracy. And if you guys stay till the end of this video, I'm going to show you the full statistics and which asset class this applies to. Now, method 1, we're going to use this EBP in order for us to identify the DOL, draw on liquidity. So we're going to use the following timeframes here, right? We're going to have, for this specific method, we're going to want to focus on the higher time frame, and you guys are going to see why. We want to see the daily, we want to see it on the weekly or the monthly. Now, ideally, I personally focus on these two, the daily and the weekly, when it comes to method 1, because it just gives me enough of a range to look to target that specific liquidity. And we're going to go and talk about what exactly is the draw on liquidity using the EBP strategy. Now, when we look at this example, let's just assume this right here is a daily candle. So we're going to assume that this is a daily time frame. Now, if we know that there's an 88% chance of this high being hit, right? So we have an 88% chance for this potential high to get hit. That gives us an edge. Now, the reason why I prefer this to use on the daily time frame and the weekly time frame is there's enough of a range for me to take advantage of this liquidity pool. So for example, if this is daily time frame from here, let's just say the market has the next candle, and I'm going to show you guys how to actually enter on this. But I know that up until this high, this could be like maybe like, depending on the asset class, if this was NQ, for example, this could be a couple hundred points. Let's say it could be a 300-point move plus, right? So if I know that there's a big enough range, I can go ahead and do that. Now imagine if this was like something like a 15-minute time frame. There's not going to be enough of a range in order for me to trade it back up into that high. Now, I could use this system on a 15-minute time frame, which I'm going to talk about in a later video for method 2. So make sure to subscribe to the channel, because I will be making additional videos in regards to method 2. But this is essentially how we would like to trade it. So inversely, when we have the bearish example, we're going to want to see that the market targets this specific low. Now, based off the statistics that I'm going to share with you guys at the end, on the bearish side is actually slightly less. It's about 83% chance that the market will come and take out this prior candle's low. And similarly, for this, again, we want to see this either on the daily, on the weekly, or the monthly. all different time frames that you can use. Now, how can we actually use this to our advantage? We know that the target for this candle is going to be the high, and the target for this candle is going to be the low, and we know that it has a very high probability to do so. Now, what we typically are going to want to see is that the next candle, for this example, on the bullish side, the next candle is going to open above here. Now, what we typically want to do is we want to use a concept called PO3, which I'm pretty sure you guys have heard of it. And if not, I'm going to talk about it briefly. Now, what we want to do is we want to see that candle open, and then we want to see the market have a drop lower. That is the power of 3. Essentially, the market is manipulating on the downside move. I'll make a separate video entirely on PO3. But nonetheless, what we're expecting is the market to come down into some sort of higher time frame level in here. So what we're essentially waiting for is to the market. Let's say there's a fair value gap, and this is a daily candle. So maybe we drop down to the 4-hour, and we see some sort of fair value gap or higher time or key level. Then we look for the market to come down into that area, potentially have a displacement move, and then we start to see the market target that candle's high. This is a perfect example. And no worries, because I'm going to go ahead and show you guys a real example of this. Same thing with here. We're going to essentially wait for the opening price. Then inversely on the bear side, what we want to see is the market have a move higher first into some sort of maybe key level inside of this overall candle's range. And what happens is we then start to look for that displacement leg lower in order for us to target that candle's low. This gives us clarity on what we're looking for when we're trying to take advantage of this, because we know where the direction and where the DOL of the marketplace is likely to occur. We know with statistical evidence that there's an 88% chance of this high being hit on NQ and for 83% chance on the bearish side. So let's go ahead, let's get into TradingView. I'm going to show you guys a full example, one from the bullish side and one from the bearish side. So here we have an example on NQ. And if you guys want to go and backtest, this is December 20th. So first, let's define our engulfing bar. So right here, what do we have? We have the marketplace taking out the prior candle low. We also took out another prior candle's low. So there's liquidity being swept and the market having displacement. Now, again, per the rules, the market has a close above the opening price. So this constitutes for me as an engulfing bar play. So now what am I looking for? I'm looking for inside of this swing low to swing high for the market to come into some sort of key level and then have displacement for us to target that area. So let's go ahead and let's take a look at this example and let's see exactly how this ended up playing out. So here's the 4-hour time frame, and if you guys see this is just an indicator that I've created in order to identify the engulfing bars. And see, notice how we have a fair value gap when we go down to the time frame lower. This is the ideal scenario where we have the fair value gap that's present, and then we have this high as our DOL. Now, some people might want to target this specific area, maybe this prior consolidation. That's really up to you. Now, all we're going to be doing is we're going to look on the 4-hour time frame for the market to have a move lower down into this area, and then a potential displacement back above. And as we play this forward, we're going to see how the market ultimately plays out. And then here, what we notice inside the fair value gap, the market actually creates, what's this? Another 4-hour engulfing bar. So you can actually use this as a confirmation entry, which I'm going to talk about in method 2. And let's just assume that you take an entry somewhere here. These types of fair value gaps where you have candle 1, candle 2, and candle 3, if you want to just buy the dip and this high is essentially your target, you can essentially put your stop loss below candle 2's low. So let's go ahead. We're going to place this trade. Entry, the stop loss would again go beneath that specific low. And then we could use this to target, like let's say a 2-to-1 on top of this, looking for a bigger move. As the market plays out, we're going to see that the market starts to have expansion move to the upside. We actually have a gap up, and the TP gets hit for a 2R move. Now, if you want to get a lot more higher risk to reward, what you typically can do is you can go down to the lower time frame, and you can actually start to look for potential entries somewhere in here on a 15-minute, on a 5-minute using daily profiles. Now you guys can see how we can actually use all the different types of concepts to bring this all together to get a much better risk to reward, much better entries, and optimize it. But for the sake of this video, we're going to just keep it very, very simple. Now let's go ahead and let's show a bearish example of the same exact setup. Now here we have an example on dollar yen. And this was on March 5th. So if you guys, again, want to go ahead and backtest this one, you can go ahead and do it. Now, if you look to the left, you already can kind of see, if you're starting to see the theme here, this is, again, the daily time frame. We had one EBP, and then look how this one also, we had another one that forms right after it. And this was going to be our DOL. So pretty much our candle bars low is going to be our target. So now, this all being said, let's go down to the lower time frame. Let's go see if we can see anything. So first, I'll typically go down to the 4-hour time frame. And again, this is going to be the overall range. And what these lines represent is, right, swing high down to swing low. This is pretty much 50% of that range. Now, notice how the market comes into that area and then we sell off. We take out this low and then we also take out this subsequent low as well. So let's go ahead and see exactly what happens during this area. And we're going to try to break it down further down to 1 hour. So the way I like to go is from daily, the 4 hour, and then down to the 1 hour time frame. Now, what do we see here on the 1 hour time frame, right? On the 1 hour, we actually see that there's a swing high down to a swing low. There's also a fair value gap that was present, and we essentially have this kind of like this order block, this range in here, where the market had a protected high, meaning there's a swing point that was created after clearing liquidity. The market has this impulse push leg lower, and then we're kind of retracing back into it. So for me, this could actually just be an entry that you can take right here because of the overall structure on the 1 hour time frame. So what can we do? Let's just say we draw our Fibonacci. And then we essentially have this swing high down to that swing low. And we draw it out in time. And let me go to the settings because people always ask. These are essentially the settings that I have for my fib. So typically around the 0.62, 0.70, that's going to be like our OTE. We want to sell at a discounted marketplace. So as we can see here, let's just say that we place our short position. Let's just say we place our short position here at the 62. Our stop loss will essentially, again, conservative stop loss will typically going to be around here, around the high. And then our target could be that low. So in this example, it would be about 1.42. But if we, let's just say we target this liquidity pool that was also present based off the daily time frame and the fib extension, that will leave us about a 2-to-1 risk to reward. So let's go ahead. Let's play this out down into that specific extension target. That would have been about a 2-to-1 risk to reward, and then you have a very solid trade in here. And again, if you're someone who goes on the lower time frame and you can time this using daily profiles and target this as your liquidity pool, this will create a scenario where you have a bigger range and you're able to get a nice specific tight entry. Now, if you guys want more videos like this and you guys want a video specifically on daily profiles and how we can use daily profiles with the EBP system, let me know in the comment section below. Until next time, I'll see you guys in the next video.